Tax planning in public sector enterprises. I am KV Ramesh, MPhil, MBA, MCom, LLB, PGDT, PGDUP, DPM, Assistant Professor in Institute of Public Enterprise. The contents include concept of taxation laws, meaning and purpose of tax planning, definition of public sector company, main objectives of public sector enterprises through tax planning, the various significant factors which are considered most vital for the tax planning to be incorporated in decision making in public sector enterprises. Concept of taxation laws. The main basis of taxation laws include both direct tax and indirect tax. The very objective of both these taxes is realize the revenue by way of tax to the maximum and to meet the budgeted sources of income, that is finance, to meet the expenses of the government of India, to find various avenues to enhance the tax collections. It also includes broadening of tax base so that the revenues from the various states as well as the central government will be on increase. Meaning of tax planning. It is a device which is carried out by a taxpayer to pay his tax liabilities and to meet the obligations in accordance with the relevant provisions of the Income Tax Act. Tax planning helps a person to claim exemptions, deductions, and allowances. There is a need to understand what we understand by exemptions, deductions, as well as allowances. The term exemption refers to that part of the income which should not be taken into computation of total income of an assessee. These are discussed in depth under the Income Tax Act 1961 under Section 10. With regard to the deductions, we refer to various heads of income, namely 5 heads: income under the head salary, income under the head income from house property, income under the head business or profession, income under the head capital gains, and income from other sources. With the various incomes so explained earlier or allowed, certain amount of expenditure which has been incurred as to be reduced. These refers to deductions. When we come to the allowances, it is the amount which is being paid in addition to the salary to the employees. There are various provisions under the Income Tax Act where everybody is entitled to take the advantage so that the tax liability is reduced to the minimum. While tax planning is aimed to reduce the tax liability to the minimum, on the other hand, tax evasion is avoidance of tax legally. The purpose of tax planning goes in accelerating the development of public sector companies by generating funds for investment in desired sectors of our country and promotes professionalism. It also endeavors to measure the economic conclusions and consciousness to every part of an SSC to provide the ways and means which would eventually benefit by minimizing the tax burden. The generation of black money always darkens any country in its economic development on the other side, in a sense, improving in an avoidable economic destruction. Tax planning is the generator of white economy. Tax planning thereby creates economic stability of the nation, of the public enterprises and its people by even distribution of the economic sources. When we go to the definition of the public sector company, the Indian Income Tax Act 1961, Section 2, subsection 36A has defined as any corporation established by or under central, state or provincial act or a government company as defined in Section 2, subsection 45 of the Companies Act 2013. Public sector enterprises, central public sector enterprises, and public sector banks are classified under public sector undertakings. So when we are studying the tax planning for public sector enterprises, we are taking into account all the streams under which it has been said under public sector undertakings. The main objectives of public sector enterprises through tax planning emphasizes for the objective of meeting the following four: reduction of tax liability, minimization of litigations so that the government or the department or the public sector enterprises in treatment of the expenditure or with regard to the deductions, allowances, perquisites not in conflict with the provisions of the various acts or with the decisions given by the courts. Productive investment. Taking the advantage of the income tax provisions, it must aim to ensure more of investment should be utilized towards productivity of the assets of the public sector enterprises. Therefore, achieving the healthy growth of the economy and economic stability is achieved over a period of time. The most significant factors for public sector enterprises when we take into account the tax planning can be categorized into the following categories, where the public sector enterprises has to take advantage of the provisions through tax planning. Namely, the areas are location of business, nature and size of business, form of business organizations and pattern of its ownership, specific management decisions, financial management decisions, employees' remuneration, mergers, amalgamation of companies, double taxation relief, and advance ruling. Let us discuss in detail the various tax planning avenues which are available under the Indian Income Tax Act with various decisions. Location of business. The selection of the location is very important and forms vital for the purposes for tax planning for availing the tax incentives. The public sector enterprises through tax planning aims in reducing the regional imbalances in growth of our country. Taking this thread, the Income Tax Act has provided under sections 10AA a special provision is introduced to give tax benefit for a newly established unit, that is, a unit established on or after the first day of April 2006 in special economic zone by an entrepreneur, wherein they are entitled to claim exemption from the total income subject to the conditions set forth and being satisfied by the concerned organization. The term conditions include the following, upon which an industry can claim exemptions, namely, the SSC starts to manufacture or produce articles or things to produce or any services during the previous year, during any relevant assessment year commencing on or after first day of April 2006. The newly established unit is not formed by splitting up or reconstruction of an already existing business and is not formed by transfer of old machinery, in a sense, existing machinery to a new business. If the above said conditions are satisfied by the industrial undertaking which has been taken up by an entrepreneur, the industrial undertaking will be taking advantage by way of deduction in the following manner. Let us discuss in detail and understand how the deduction is provided to an entrepreneur. For the first 5 assessment years, a deduction of whole of the profits, that is 100% of the profits from the export business of such articles or things manufactured or service provided for 5 consecutive assessment years, and for the 6th to 10th assessment years, half of the profits derived for the next 5 assessment years, and from 11th to 15th year, deduction is allowed to the extent of 50% of the profit derived only if the company has debited to the profit and loss account of the previous year an equivalent amount and credited to the Special Economic Zone Reinvestment Allowance Reserve account. Once these conditions are satisfied, the deduction exemption is allowed. Section 80IB creates a deduction for a company other than an infrastructure undertaking, and it includes an industrial undertaking engaged in shipping business, companies engaged in industrial research, industries engaged in production of mineral oils, industrial undertaking involved in developing and building housing projects as works contract, business involving processing, preservation, and packing of fruits or vegetables, or integrated handling, storage, and transportation of grain units, undertaking getting profits from business of hospital which has been set up in a rural area, nature of business. Income of venture capital fund or company is exempted from income tax under section 10 subsection 23FB. Similarly, section 10 subsection 23FA provides an exemption of income by way of dividend and long-term capital gain of a venture capital funds and venture capital companies. Income derived by an infrastructure capital fund, infrastructure capital company is exempted under section 1023G. Section 35ABB is a section which provides a deduction which is relegated to telecommunication services for the expenditure incurred being capital and is spent towards acquiring any right to operate telecommunication services. The amount of deduction is allowed in equal installments over a period beginning from the year in which the payment is made and ending in the year in which the tenure of the license comes to an end. Section 35D provides a deduction with regard to the amount of expenditure which has been incurred towards preliminary expenses. It goes by way of selecting a choice with regard to amount to be deducted limited to 5% of the cost of the project. The term cost of the project includes the amount of fixed cost plus working capital as well as 5% of capital employed, whichever is more. The term capital employed is referring to the net worth. Therefore, it is for the company to choose between the deduction to be allowed as an amount qualifying as a percentage on cost of the project or cost of employed with regard to capital employed as well. Incentives linking to the nature and size of the business. Specific provisions has been created taking into the nature as well as the size of business depending upon the location at which they have been taken up. Section 80IC provides a deduction from the gross total income of an industrial undertaking located in specified category of states wherein the business is involved in substantial expansion of production of articles in the states of Sikkim, Himachal Pradesh, Uttaranchal, and northeastern states. The deduction can be enjoyed for 100% of such profits for a period of 10 years. Section 80LA also allows a deduction from the gross total income where an assessee is deriving income of scheduled bank having its offshore banking units in a special economic zone or a foreign bank and having an offshore banking unit in a special economic zone or a unit of International Financial Services Center. Deduction can be claimed as 100% of such income for a period of 5 years. Form of the business organizations and pattern of its ownership also matters with the most important as tax liability base. As we know, the SSCs are classified. Depending upon that, the benefits are also flowing to the SSCs. Tax planning through tax incentives play an important role while selecting a suitable form of organization for a new business. A decision can be taken by comparing tax liability under different organization forms depending upon the residency status being resident or non-resident. Specific management decisions. Due consideration must be given to tax implication as well as which certainly influence the decisions positively or inadequacy of exploiting or identifying the provisions will render the company losing the benefits, tax advantages, and accordingly the decision must be taken to buy or to make. It should be noted that the cost incurred in making a product and buying a product both involves incurring of an expenditure, that is revenue expenditure. The tax consideration should be taken into consideration if the decision is to manufacture a part or a component which involves setting up of an industrial undertaking, then tax incentives which has been exclusively set out under section 10AA, 10B, section 32, 80IA, 80IB should be explored and to be considered whenever we are taking the decisions like that. If the enterprise is taking a decision to sell a plant and a machinery or buying is cheaper than manufacturing and the SSC decides to buy the parts of the components along with the period for which he may have to like to sell existing plant and machinery, due provisions of section 50 are to be taken into consideration. When we come to the most important decision with owning or leasing, it involves huge amount of expenditure which is nature of the benefits which is going beyond the year and the expenditure which is more exclusively incurred towards acquisition of fixed asset known as capital expenditure. Danger of outdated or obsolete machinery is always a danger. Leasing decisions will not involve an incurring huge capital investment. Only lease rentals can be claimed as a deduction as against the depreciation in case of owning an asset. The company carrying on the business of seasonal products or an intention to carry on the business for specified short duration, leasing decision would be advised as against owning. Repair, replace, renewable, renovation decisions. The consideration should be taken into account whether the expenditure relegated to repair, replace, renewal, or renovation are allowed or capable of being claimed as deduction under Section 30, 31, or Section 37, subsection 1. If the expenditure is deductible expense, then the cost of financing such expenditure is reduced to the extent of tax saved. On the other hand, if such expenditure is not allowed, it may be capitalized, and on amount of so capitalized, depreciation is available if certain conditions set forth therein have been satisfied. When we come to the financial management decisions, it more so concerned with how you have made the structure of a capital. The term structure we refer the components of share capital, that is equity, preference, or it has been used with the debt component. The factors affecting the decision would include the risk, cost, control, and tax implications when we take certain instrument as a part of your capital. Employees' remuneration. The important aspect of tax planning by a public sector enterprise with regard to the employees' remuneration takes into account the following: optimum combination of allowances and perquisites, deductibility of remuneration paid to the employees. If not eligible for deduction, then the taxable income under the head business or profession of the company shall be more. When the remuneration is received by employees, is taxable in their hands at a concession rates to minimize the tax liability. Mergers and amalgamation of a company is the nature of the business in today's competitive world. The amount of expenditure in making the amalgamation or the merger are allowed as a deduction under Section 35DD of the Income Tax Act. It should be carefully seen that this section provides that even the capital expenditure incurred towards amalgamation qualifies as deduction. Double taxation relief. The term double taxation is a relief from the tax liability to an assessee whose income is taxed twice. That is, income earned in a country of residence is different from where the income is generated. In case of individual having residential status, being a resident and ordinarily resident, and in case of company resident, they are liable to income tax for the income derived from Indian income as well as foreign income derived during the previous year. A situation in which the same income with regard to which two or more taxes may need to be paid for is known as double taxation. It is not to be misunderstood that we will be putting the tax twice in both the countries if an assessee has derived the income so. Therefore, Section 90 and 91 exclusively deal with relief for such amount of income which has been derived outside, and where the need when it is to be taxed should be given as a relief. Let us know specifically what the Section 90 and 91 goes with explanation with relief. Section 90 provides the central government entering into agreements to provide relief known as bilateral, whereas Section 91 provides for tax relief where there is no agreement entered by the central government known as unilateral. Most of the countries with the India have already packed into an agreement under Section 90. The benefit of tax relief under Section 90 is provided by wholly avoidance of that part of the tax that is taxed twice or allowing partial income tax to be paid. The term partial income tax to be paid should not be understood that they are taxed for part of the income, but however, the income which has been earned earlier in any other country other than the domestic country on which tax has already been paid. Once we are computing the total income of the SSC for the assessment year, the same income will be taken into account within the term total income. However, when it comes to the tax liability, the relief will be given for the amount of income which has been earned outside as well as the tax which has been already paid. Section 91, on the other hand, provides a unilateral tax relief by Indian government to resident individuals whose income includes income accrued or arise outside India during the relevant previous year. It should be kept in mind that Section 91 relief is available only if Government of India has not entered into agreement in which the income accrues. Advance ruling. The prime objective of setting up the authority for advance ruling is basically to avoid the unnecessary litigation and to clarify any non-resident about the tax implications relating to a transactions taken up or proposed to be taken up in India. The determination of authority in relation to a transaction which has been undertaken or is proposed to be undertaken by a non-resident applicant with respect to the question of law or the question of fact arising out of the transaction which is to be entered in relation to which tax liability of a non-resident when the transaction is arising with a resident applicant in respect to an issue pending before any income tax authority or appellate tribunal relating to the computation of total income. Thank you.